Have you ever heard of Quitters Day?
Never.
Never. Okay.
Is this like a national holiday that they've made up?
This is not a national holiday, but the second Friday in January is known as Quitters Day, which is when people are most likely to throw in the towel on their New Year's resolutions.
2 weeks in.
2 weeks.
So that shows what the natural human perseverance is that we have about 2 weeks of in it before we actually start quitting.
Right. So this is a status check of your resolutions or goals. How are they coming?
If you remember, my kind of goal was to like contact people and be more in touch with people. I think it's too early for that. Like, it's been super busy to even start it. So like I technically can't quit something I haven't even started a few weeks in. I did kind of do the whole workout thing where I was going to work out more. And I have actually kept with that portion. So that's still going. Although today was one of those mornings. my wife said, "Are you going to work out?" I'm like, yeah, I don't think it's going to happen. So I'm going to have to make it happen when I get home. But that's, if I hold myself accountable till to the end of the day and still do it, I still could make it happen.
Yeah, I see. My answer is vague. It's I am, I was describing them as 2024 goals. This isn't a resolution, and it's like you said, it's too early to tell. I have been working towards those goals. Some goals more than others, and some goals are just to do a particular one thing this year. And so there's a whole nother 12 months. Not that I've been putting it off, but it's hard to accomplish it in the first 12 or first, what is this? 12 days. It would have been 12 days in the year for New Year's resolution. So, anyway, all right. Well, I might do a vibe check here over the summertime to see where we are. That's the real question is in June, where are you with your New Year's resolutions? All right. Well, a lot to talk about. It's been 3 weeks actually. So, we haven't stuck totally, speaking of New Year's resolutions, we haven't stuck totally with our bi-weekly, every other week schedule, but here we are this Friday. We'll still have 2 in the bag for January, and we'll be back on track for February. Lots to talk about. And you ready to dig in?
Yes.
All right, let's do it. All right, welcome back, everybody. If you can't see on the screen and you're listening on the podcast, your podcast app, I'm Brian Ullman. I'm a financial advisor here at Ford Financial Group. Joined again by Ryan Louie, also a financial advisor, also a CFP here at Ford Financial Group. And this is the Casual Friday Financial Insights podcast. We record this on video, so if you're watching us on YouTube, welcome. This is the point in the script where I have to say, click right here, hit subscribe, hit the remind button. That way, if you're a client, you're getting our latest thoughts on kind of what's going on. And if you're listening to this on wherever you listen to podcasts, which is where we do this as well, whether it's Spotify, Apple Podcasts, all the others, you can hit subscribe and listen to us regularly as well. We also have this on the front of our website. So if you go to our website and you're listening, I'd say take a look at and subscribe wherever it is else that you're listening. Ryan, I know you listen to some obscure use some obscure app to listen to your podcast. What do you think is our most popular platform for people to listen to us on, not including YouTube?
Actually, the fact that you mentioned the website, I can see people going there. It's just easy for people to remember where to go to. Either that, or they subscribe on YouTube and they listen to us there.
So the most popular is Apple Podcasts.
Yeah.
So now I think, not to get too deeply into the weeds here, I think a lot of discovery goes on when people go to our website. Because when if you look at the stats, there's a pretty good chunk of people on websites. But for apps, well, I'll just tell you right now, for apps, Apple Podcasts is a little bit more than a third of the people who listen. The web browser, which is probably the website, is about 7%, which is tied for third with iHeartRadio.
I don't even really, I can guess that's an app, but
iHeartRadio is
not something I've ever come across.
iHeartRadio is a little bit like TuneIn or SiriusXM in that you pay a premium and you can listen to radio stations.
Okay.
Um,
Okay. I figured
this
that some people might go onto the website, they bookmark the site, and then they do it that way. I was taking a stab in the dark with that one.
Yeah, I'm surprised not more are on Spotify, but for devices, our most popular device, 50% is iPhone,
Okay.
and then 76% of people listen on mobile. So even if it's on the website, it's still on the cell phone, which
Yeah.
I think realistically is where most people are. I'm out of focus again. Where most people are doing their computing, right?
Yep. That makes
It's
sense.
it's the most common computer. Interesting note, and then we'll actually get on to the economic data. 5% as far as devices is mobile computer. There's an unknown category if they can't figure it out. Smart speaker. 5% of people are listening on a smart speaker.
Oh, interesting.
So, hey,
Hey, Alexa.
Alexa or SIRI, or
Yeah.
I don't want to say it all out loud because it'll trigger devices, of course, if someone's listening openly. But yeah, it's a little bit everywhere. But top app, Apple Podcast; top device, Apple iPhone; top category, mobile, easy. That's like the lead is pretty large there. All right, let's get in. We'll start with a little bit of market recap like we usually do. You can see here, it's kind of hard to see if you're watching on mobile. If you're listening on mobile, you can't see it at all. So I'll give you the quick rundown here. We hit all-time highs last Friday, the 19th, and have been moving from there. Year to date, NASDAQ is the best performer. So year to date, the NASDAQ is up, including where we sit here today as we record. NASDAQ is up. Well, what's that? About just short of 4.25 on the year. S&P 500 up about 2 1/3. Dow up about 1/3%, just barely above break even for the year. Small caps, the Russell 2000 down exactly 3% at this very moment. So I think what you can see here, Ryan, so far, what we're almost 4 weeks into the year, large cap tech as
It seems
represented by
like it's a
NASDAQ.
repeat of what was happening last year, in terms of leaders and laggards.
Sure.
Yeah. And, maybe it speaks to a little bit about what um, the market is saying about going forward too. Because if we do have any kind of economic slow, now obviously the market's up, so it's not saying that it's not feeling like we're having an economic slowdown. I'm just saying if we were to have an economic slowdown, it usually means that small caps get hit harder because they're the ones that usually can't withstand some of the slowdown as much as the larger companies can. So that there's a lot of talk right now just about the divergence between the small caps and large caps. It's like the largest
Sure.
it's basically ever been, given how much the large tech companies have really done well.
Well, yeah, it's the old Magnificent Seven, right? I won't list the names, but the knock on, especially on the markets last year, was that only 7 names out of the S&P 500 were the ones that were really propelling growth. It's a bit of a misnomer. There was more than that were doing well, but certainly those were some of the best names last year. And mega cap tech is at it again. Just because we flipped the page from December 31st to January 1st doesn't mean the conditions have changed necessarily,
Right.
for what's going on with the market. And so maybe that's a good reason why it's more of the same.
Well, as of a couple of days ago, it was actually really, I think, just 2 of the Magnificent Seven that was really doing the heavy lifting. And
Yeah.
again, this year's early. We're only a few weeks in.
Yeah, and I would say there's only one name that is really doing poorly, and without naming the name, it is a car company associated closely with technology. Well, and so we mentioned that we have all-time highs, so we can just go ahead and dig into the charts here. This is a chart of stock market all-time highs since 1980, and when we say that market, we're talking about the S&P 500 here. When a market hits an all-time high, it's it oftentimes markets have momentum, it's either up or down, and so that's why you'll see big chunks of new all-time highs, because it goes higher and hits that mark and then keeps raising the bar and raising the bar. And then there are very lean periods where we don't have all-time highs, and you can see, for example, late 90s and early 2000s, we had 4 all-time highs in 2000 before the tech wreck. And then tech wreck, Enron accounting scandal, 9/11, it made it so we didn't get back to those all-time highs. It's not that money couldn't be made in investing, but the S&P 500 didn't hit all-time highs over that stretch until, right after, I guess, we hit 9 all-time highs. Was it 6 or 7?
Right.
Yep.
Yeah, that was a brutal period right there. It's a long stretch of, a whole lot of nothing going on.
Yep.
It's not like you didn't make money some years, but it's just that if you were in the market earlier, you're just catching up for the money that was lost in
Right.
previous years.
Right.
That just shows really that there was a 1 year in a almost a decade plus where it started making highs for a very short period of time, and then it went back. Then it went back down.
Now, if you're waiting for all-time highs, you would have missed out on 2009, 10, 11, 12, right? It took a few years to get back to all-time highs, but that doesn't mean your investments couldn't make money in some of those years. But you can see the run was huge, and in 2020, 33 all-time highs, 2021 all-time highs, 2022 all-time high to start January, and then boom, we started dropping in 2022. 2022 was a terrible investing year. And last year was a good investing year, but not good enough.
Right.
And so as of January 25th of this year, we've now hit 4 new all-time highs, which means hit on the 19th and went above a couple of times here. So it's been, even though markets are up a little bit, even just being up 1 point higher than the all-time high counts as a new all-time high. A bit of a misnomer, but it shows momentum, I think, don't you?
Yeah, you can definitely see there's momentum here because there's clusters, right? You're either having new highs or you're having years of lots of no new highs at all. One of the things that you often hear is that investors don't want to invest when they hear like new money, right? Maybe they don't want to invest when they hear that we're at new all-time highs because they think, well, geez, I don't want to buy at the high because that probably means it's going to go, it's going to go lower if I'm paying so much more right now, or I'm buying at the peak. But as these charts really show, it's like you do want to, for the market to keep going up and up to the right, you're going to have high after high after high. Yep. And so it really shouldn't dissuade you from investing just because we hit a new all-time high.
No, in fact, I think it would be the opposite. We don't have the slide, but there's pretty good evidence that all-time highs beget all-time high. You get the momentum. And so if you're hitting all-time highs or close to it, it's actually a really good time to invest. Correct. Because you're catching it as the momentum is moving higher before we can go on quite a run. If you're inclined to not invest at all-time highs, well, then the Russell 2000 would be your thing because we are still not there for the small stocks, for the small company stocks. Right. And like we've talked about with the Magnificent Seven, so to speak, this is an equal weight index returns for the S&P 500, and you can see since 2019. Market weighted stocks, so the largest stocks or the index that has the largest stocks have performed quite a bit better than an equal weighted index that just has everything in there equally. I think a lot of people think that the S&P 500 has 500 stocks and holds equal amounts of all 500 names. That's not true.
Right. They're sized by market cap of each of the stocks. So yeah, I mean, to speak of your equal weight, so that the dark line is what you're talking about. If every 500 company had the same weighting, that's the return over the last approximately 5 years of each company having the same weighting versus the largest 50 at the top, or even the S&P 500 as a whole, which again is cap weighted by company.
I think you look at it basically means it's better to own more of the biggest, right? And when we're talking about the biggest, we're talking about the biggest names.
Well, like you had mentioned too, when the markets are making highs, or consequentially when they're not making highs, it seems like there's kind of a momentum there, right?
Yeah.
There definitively has been a lot of momentum with the big technology names in terms of what people seem to want to own and what they keep putting money into. And which companies have continually just outperformed. Like the momentum has been there for many years now.
Well, do you You want to take a stab at the top 10 names of the S&P 500?
Yeah. The S&P 5. Well, it's going to be
This according to this is Slick Charts.
Yeah.
Let me see
Amazon, Google, Apple, Microsoft, Nvidia, Visa in there.
Let me see. I want to make sure that I've got the timing right. This is June 2023.
I wonder if Visa, Berkshire, are they part of there?
Berkshire's in there. I don't have a date on this though.
Tesla. I mean, it's like I said, a lot of technology. Google is in there. Sometimes in some ways they're in there.
It flips around. This is in, I don't know. I don't know the recency of this. So just take it with a grain of salt. Microsoft, Apple, Nvidia, Amazon, Alphabet, Google, Meta, Facebook, Berkshire. Oh, I guess it's Google Class A and C, both.
Yeah, they take up 2 spots.
Yeah. Meta, Berkshire, Tesla, Broadcom.
Broadcom is not one that I would think of unless I'm looking at that chart all the time.
No. Well, as of mid-year last year, this is according to Investopedia, Apple, Microsoft, Amazon, Nvidia, Google twice, Tesla, Meta, Berkshire, United Health. That's mid-year last year. And this is going to change pretty regularly. I cannot figure out for the first one that we listed what the data is. But you get the idea. These are mega cap tech names at the top, and they're the ones who have done the best. And so if you take the largest, it's done the best. And, you know.
Well, that, and if you like, this chart's 5 years old, you know, over that course of time, a lot of those names have been consistent.
Changing.
These
the tippy top has been consistent.
Yeah, those top names over the last 5 years have pretty much been a lot of them have been in there.
Sure.
And so that hasn't changed significantly.
Yep. Let's talk bonds.
Okay.
What do you say? We will jump into some bond slides here. These are seasonal patterns. So bond market volatility, you know, we talk a lot of stocks. 2022, I know we're now into 2024, but 2022 was a wretched year for bonds. Worst performance for the aggregate bond index in 2022 than 2008, which you can see this is volatility. Now, the global financial crisis had us off the charts, as did COVID, but their bond market volatility in 2022 was higher than it was during COVID. It's crazy.
Yeah, it was higher. I think the interesting thing to take away from this, though, is if you look like at the base of the volatility, like how long it's been there, we had spikes, right? Like 2009 was a large spike, and then it still stayed high after the spike came down. But definitely COVID was a very short spike upwards. And so you could tell that it wasn't very long lived. Versus what we've experienced from 2022 to present day is historically high, but it's also been happening for a very long time as well.
Yep.
And we're not out of it because we're still in this period where we're off the highs of the last couple of years, but it's still much higher than it has been historically.
Average is 85, latest reading 106. I think we have a ways to go, and we're not going to get down. We're not going to revert to average until we are until we start seeing rates fall.
Well, I would say this too, like for people that can see this chart, we spent the better portion of like the 2010s not even near the average. Like, you know, we spent lots of periods of times, probably, let's just call it on the index level, probably closer to, I'm going to say 60 or so. Yep. And like pretty low levels where we didn't worry about the bonds, right? They were just kind of in the portfolio. They didn't have a lot of volatility.
Right.
And then, you know, we go from something like in the 2010s from a 60 on the index to where we sit today at 106. It's pretty significant change in volatility.
Yep. Well, and it corresponds with interest rates going through the roof in 2022. I mean, you can almost chart, if you laid over one of the Fed fund charts on this, you just see it go right straight up. We get to 2022, they start cranking rates, bond volatility is all over the map.
Yeah, you know what? I bet you if you had, have you ever seen those charts where the Google charts where they show you by search, like it's a chart showing like how much a keyword search?
Yeah.
I bet you if you typed in like Federal Reserve or Fed funds rate, something like that,
Yeah.
you would see that this would correlate with this bond, this volatility right here. At least recently. I'm not saying over the entire portion of the chart, because again, in COVID times, the bond index volatility was high. It wasn't because of the Fed, but more recently, I would think that this is again the whole reason why the volatility is there is because of the Fed, and people are probably searching those keywords up right now. I'm sure as that keyword dies down, so will the volatility.
Yes. In fact, I'm looking. Well, I'll pull this up later. Not interestingly, the Fed search criteria on Google Trends spike every Fed meeting.
Oh, shock! Right, shocking.
Yeah. So like there was a spike in the middle of or kind of towards the end of September. There was a spike in between October 29th, November 4th. That's when the Fed came and said they weren't raising interest rates. And then again, middle of December. We don't have January quite yet, but still interesting nonetheless. We'd have to look. Let me see if I can go 2004 to present. Oh yeah. It peaked. Where is this? Oh, that's 08. Peaked again, 11. Peaked again, 2020. Peaked again, July 2022. So, yeah,
okay.
There you go.
Yeah.
Good intuition there, my guy. Let's take a look. So, that's the bond market volatility, right? Volatility, I've talked with clients about this a lot. Volatility doesn't mean down. I think a lot of people say, oh, things are volatile. And what they really are just afraid to say is that things stink. But volatility is down and up, right? You're writing it up and down, and it's back and forth. You can see here, these are the bond market total returns and pullbacks. If you've watched this at all, you've seen the returns and the pullbacks change depending on what's going on. We show the stock market version of this quite a bit, the S&P 500 version. But you can see last year, aggregate bond index up 6%, but at one point it was down 7% on the year. 2022, it finished down 13%, but at one point was down 17% on the year, which dwarfs 08. 08 was actually positive for bonds, believe it or not. We had a drawdown of about 5%, but nothing. We haven't seen anything like that. Even when rates were were raised in late 2018, we had a 3% drawdown, but bonds were flat for the year. I mean, this spells out how badly bonds were crushed.
Yeah, it's a nice chart to kind of show just how bad, especially 2022 was. You can also take a few other takeaways because we oftentimes don't pay attention to drawdowns in bonds, not on a calendar year basis. And again, as I mentioned before, kind of the 2000s, this is called the first couple of decades, the drawdowns were minimal. You had a couple of 5% drawdowns, but you had a lot of years where it was, a 2% drawdown for the year. I mean, that's not registering as a concern for investors. But then you go to the right side of the chart, and starting in COVID, you have a -6, a -4, -17, -7. Those are a lot larger than things have been than previously on this chart.
Well, and that corresponds perfectly with the volatility that we just saw on the previous chart, right?
Yes.
Volatility goes up, larger drawdowns, even with positive returns. And I think you can look back a little bit further in history and say, okay, well, when the Fed's cutting rates, the bond market can be pretty good. But even just in the last decade, bonds weren't as reliable as they were before the great financial crisis.
Yes.
Right. You get regular volatility, but pretty solid returns. If we go back to just before 2003, bonds were up 4%, 4%, 2%, 4%, 7, 5, 6, 7, 8, 4. That's running like clockwork. And it's made life really difficult for people who have what most would describe as conservative portfolio, meaning you have a lot of bonds or more bonds than stock. But bonds aren't doing for you in these last few years what they were doing for you before. So that's where alternatives have to come in, maybe annuities. If you're real risk adverse, maybe bonds aren't doing it for you any longer, and you've got to get creative.
Yeah, we said too that the volatility still persists today. I mean, you think about the last few months, we had a nice run up, right, with the bonds. The bond
Yep.
market moved up in both November and December very nicely. It's the reason why we really have that 6% gain.
Yep.
But then you get back into the new year in January, we're a few weeks in, and it's already down 2%.
Sure.
Right. So again, that nice run up lasted for 2 months, and then back to some volatility, at least on the downside to start the year.
Yep. Well, and we're down 2% this year. And in
Right.
fact, go back to our original chart that we were looking at. This is the iShares Core Aggregate Bond ETF, which mirrors the bond index, down, 1% and change. It's up a little bit today, but compared to the S&P 500, that's a pretty big spread. That's year to date. You look at it for 1 year. If you've held bonds from the end of January to the end of January, your bonds are up 1%. And that
Yeah.
only happened in the last few weeks. Meanwhile, the S&P 500 is up more than 21%. Stretch it out 3 years. Bonds are down 10% versus S&P 500 being up 27%. I mean, do you want to be a bondholder? Bonds are up 3.77. The ag is up 3.77% over 5 years versus almost 85% for stocks. Yeah, you rode a roller coaster ride for stocks, but good gravy. Look at this. 10 years?
Now, the one thing that this isn't incorporating, right, is that the interest payments.
Interest
So we
payments.
gotta caveat we gotta caveat that the bondholder would have gotten interest, which is a very important factor of being
Yeah.
a bondholder.
Yep.
So over, let's say, the January period, yes, you're probably not picking up much interest rates because we're only a few weeks in. But over the last year, you would have picked up a year's worth of interest rates to add on top of that
Yeah.
return that you saw.
But if you go back further, we were going 5-10 years. Rates were garbage.
Sure.
So
Just
yeah, you were
the
picking up.
disparity is still there between stocks and bonds.
Yeah. I mean, even with the dividends or the interest being reinvested, you're still not catching up. And here's the two of them together, like we were just looking on the other side. This is year by year, though, and you can see the Bloomberg Aggregate Bond Index versus S&P 500. Boy, if you have either the time frame, meaning you're not close to needing the money, or you are not risk adverse. Boy, doesn't this just tell the story? Like if you're under 50, do you need bonds in your portfolio, Ryan?
Well, again, like I always say, it comes down to the client being, with their risk tolerance, because you're just part of it that said you're young enough that you should push the envelope and take on risk. At the same time, everyone's wired differently. I also will say this though, like we went through that period where bonds really did bad, paying low interest rates. Then they themselves were paying low interest rates, and then interest rates went up, and it hurt the bond values. We're at a much different. We could argue though, right now we're at a much different stage in terms of what we think that they can deliver to us. That
Yep.
historically, well, at least the last handful of years, they weren't in a position to give good returns. They're looking attractive, at least at this point.
Well, the reality here is bonds are, not having stocks in your portfolio in whatever form, a lot has to do with how quickly you need the money. So we can't just say you're young, you need all stock, no bonds. Because if you're 16 and it's your college fund and you're applying for colleges and need to use this in 2 years, you don't want to have a year like '08 that suddenly turns your USC tuition into city college tuition, right? Or junior college tuition. But if your time frame is longer than that, and generally it is for people who are younger, especially putting into their retirement accounts, think 401k, IRA, stuff they're not going to take from, boy, this tells the tale,
Yeah,
It,
I would say too, if you looked at bond returns like the last 5 years, we always say, usually, I mean, more on the upside when things are looking really good, you say, past performance is not indicative of future performance,
sure.
right? I would actually say that really applies in a different way with the bonds, because the bonds, if you looked at the last 5 years, why would you want to touch them, right? Because the performance looks like, if you're gonna extrapolate that into the future, you'd be like, no, I'm not gonna hold bonds. But
Sure.
I don't think that the last 5 years it's indicative of what we would expect the next future 5 years to be.
No, and we could have rates falling. We touched on this last time, and it doesn't happen often. But if you look here in the early 2000s, bonds actually outperformed stock in those 3 years, and we've got these conditions where if we really hit a recession and only good news is priced into stocks, but interest rates are falling. There's a very real scenario here where in this year, bonds outperform stock. Is it going to happen every year over the next decade?
Likely not, but
likely not. I will say, I'm going to take a victory lap here real fast. Early 2012. So this is 10 years, more than 10 years old now. We were coming out of the Great Recession. They were calling them Gen Y. I don't know. I guess that would be millennials, right? Investors born between the early 80s and the late 90s.
Yeah.
They were calling them Gen Y. I think we call them millennials now. So that goes to show how long ago this was. But they were, I don't know if you remember this, but we would have new people in the late 20s, early 30s, and they wanted all bonds. They had more conservative portfolios than their parents and grandparents. It was nuts. And it's because these were really formative years that they watched markets absolutely blow up. You can even see it right here in the middle. Like, you don't track markets, point out 2008, right? It's the dead center, the one that goes straight down and hits almost negative 40%. But at the time, we were having to encourage these people, hey, get into stocks. Now's a good time. I know it's been lousy, but trust us going forward. That's an outlier. And so I was interviewed by the Wall Street Journal, and it's easing 20-somethings into stocks. These are 30-somethings now. And it was saying that they're all worried about risk, worried about whatever. And we were saying, here we go. Brian Ullman, advisor of Ford Financial Group in Fresno, counsels the children of his older clients. And he says many aim for limited risk portfolios commonly associated with investors twice their age and perhaps only have 30 or 40% in stocks. If you went back and followed our advice a decade ago, you would have had a great run despite what went on here just lately. I will say, I don't know why they chose me at the Wall Street Journal interview, but we've got the receipts and we were right.
Yeah.
Going
hang that up on your wall.
Right call.
Now you only need to make a prediction about what the next 12 years is going to hold for us.
I'm going to say the same thing. If you're in your 20s and you're putting money in your 401k, don't be a ninny. Set it and forget it. Don't even look at it. Come back in a decade. Again, we'll talk. I'll be right. And it's not because I'm clairvoyant or you're clairvoyant or any financial advisor's clairvoyant for that matter. It's because the track record over a decade is pretty reliable. We've had one 10-year stretch that included the tech wreck and the Great Recession together in that 10-year band where bonds outperform stocks. All other times through history, stocks have done well over every 10-year period. The next 10 years is going to be no different. I don't care who's running for president or becomes president. I don't care what goes on geopolitically.
That is one thing that I do to tell people that are younger, because you do find you will find young people that are risk adverse, right? And so they if you ask them what they would want to do, they're going to say, I want to be more conservative. I like cash. I like bonds. I don't want a whole lot of stock. And then it is our job to try to talk to them about what the outcome of that would be by taking too little risk when you're young. So just because you're wired a certain way, it doesn't mean that I'm going to just let that be how we dictate your portfolio. I want to have a deeper discussion to see if we could position somebody to where their age is maybe a little bit more important of the dictating factor.
Well, and explain, this is about when you're taking the money out. And if you have a non-retirement account, meaning money that you're investing that isn't tax sheltered, deferred, or whatever, maybe you're saving it for something, a wedding, a car, a house, whatever. Okay, so that the time frame then shortens there. But let's also say you're putting money in a 401k or you're putting money in an IRA and you're 35 years old. If you take it out before 59 and a half, you're going to get taxed and penalized. You'll only get about half of what you are taking out. The rest goes to taxes. Realistically, let's just say you're going to retire at 65, which we don't even see a whole lot of exactly right now. You've got 30 years. You got 3 decades that this is going to cook before you take the money out. If you got a 3-decade time horizon before you even touch the investment money, foot on the gas pedal.
Right.
Period.
Right.
Period. End of discussion. I hope. Well, I don't know. I think it's interesting. Bonds have, none of this is forward looking, right? This is all backward looking. Every single chart is saying what has happened before. It's impossible to say what's happening in front of us, but we can read the tea leaves and say, well, interest rates are probably going to come down. Generally, that helps bonds, but it can help stocks as well. And in the short run, bonds might do pretty well to come as the pendulum swings in the other direction. But in the longer run, stocks probably do better just based on history. I don't know.
It's a safe way to go, more stocks the younger you are.
Yep. All right. Well, I don't know about you, but I'm getting a lot of politics questions. And so we are not going to address that today. We just had the Iowa caucus, New Hampshire primary. It seems we know which two candidates are going to be running for president, but when you are these two candidates' ages, nothing is guaranteed, especially with some legal stuff in limbo with one of them. We will come back to this question because if we're getting asked about it a lot, people want us to address it. And so maybe in the next one of these, or as we get a little bit deeper into primary season, we can talk about what things look like with election results and in election years.
Yeah, I think it's worth going over like the history, some of the data of what previous years, election years look like.
Yep.
I think people will be a little bit surprised by, what they think happens versus what actually happens.
Yeah.
So I think that's definitely worth exploring because,
totally. I find that people think that if their candidate or their party wins, it's going to be better for markets. And here's the reality. Markets don't care. They're ruthless capitalists. Yes. And they're just going to bet a certain way depending on who wins and make money either way. I don't want to ruin this though. So we will tease it. If you want to hear about God help us, when we do this political discussion, if you want to hear it, not miss it either. If you're watching on YouTube, subscribe. If you're watching or listening on one of the podcasts, Apple Podcasts, I'm shocked that Spotify wasn't on the list at all, but in any of those, hit subscribe. I think there's even a ring the bell for the alerts if you want to do that. You can email us at info@forwardfg if you have specific questions that you'd like answered. And when I say specific, if it's specific to your portfolio, we'll try and talk generally. If it's specific investment questions or hopefully more general investing questions, we can answer those either here on the podcast, or if not, we can contact you directly. Also, if you're a client of Forward Financial Groups and you want us to forward a question to your advisor, you can email us at info@forwardfg, and we will forward that on to them. And if you have a different advisor and you just want a second opinion, send us an email and we can respond to you and even maybe set up a half-hour phone call or a meeting so we can go over things with you. So, Ryan, let's leave it there.
Sounds good.
We will do this again here very shortly so we get back on our 2-week roll.